Banks are the silent engines powering modern life. Every salary, every loan, every payment flows through their systems. Yet most people see banks as simple vaults for money, not realizing their true complexity. Banks don't just store wealth, they create, circulate, and multiply it. Understanding how banks work is essential for making smart decisions about borrowing, saving, and investing. In this video, we'll break down the banking system from the ground up, revealing the real mechanics behind every transaction and how banks shape the economy. Let's start by exploring why banks are so central to our daily lives. Many people misunderstand banks. They imagine their money sits untouched in a vault, but that's not the case. Banks are profit-driven businesses, using deposits to fund loans, earn interest, and generate returns for shareholders. A bank loan doesn't come directly from another customer's savings, and interest rates aren't random, they're carefully calculated risk premiums. By demystifying these misconceptions, you'll see banks as dynamic institutions, not just passive storage facilities. This knowledge helps you engage with banks from a position of strength and clarity. Bank is a licensed financial institution that accepts deposits, provides credit, and offers a range of financial services like payments, investments, and foreign exchange. Banks operate under government charters and are regulated by central authorities. Before banks, people with surplus funds had no efficient way to lend to those needing capital. Banks solve this by connecting savers and borrowers, charging for their services. Their role in the economy is vast, from allocating capital to managing payment infrastructure, creating credit, absorbing risk, and influencing economic activity. Banks are central to economic growth. They allocate capital, direct funds from low productivity to high productivity uses, and provide the infrastructure for all electronic and cash transactions. Banks expand the money supply by issuing loans above their reserve levels, manage financial risk, and signal economic conditions through lending rates. Their decisions ripple through business investment, consumer spending, and the broader economy. Understanding these roles helps you see banks as active drivers of growth, not just passive participants. Banks come in many forms, each serving a unique purpose. Commercial banks handle deposits, loans, and daily banking for individuals and businesses. Central banks manage monetary policy and regulate other banks. Investment banks focus on capital markets, mergers, and underwriting securities. Cooperative banks are member-owned, supporting communities and agriculture. Digital banks, or neobanks, operate entirely through apps with no physical branches. Each type plays a distinct role in the financial ecosystem, shaping how money moves and grows. Banks' main profit driver is the interest spread, the difference between what they pay depositors and what they charge borrowers. This is called the net interest margin (NIM). For example, if a bank pays 6% on deposits and charges 9% on loans, the margin is 3%. Multiply this across millions of accounts, and you see how banks generate core revenue. Beyond interest, banks earn from processing fees, credit card business, foreign exchange margins, investment product commissions, and treasury operations. Credit cards, in particular, are highly profitable due to high interest rates and fees. Banking system operates on a continuous cycle of deposits and loans. When you deposit money, the bank owes it back to you. It's a liability. The central bank requires banks to keep a fraction of deposits as reserves, but the rest is lent out. This cycle repeats as borrowers deposit loan proceeds in other banks, which then lend out a portion again. This process multiplies money in the economy, fueling growth and activity. It's the foundation of how banks drive economic expansion. Fractional reserve banking is the system where banks hold only a fraction of deposits as liquid reserves. The rest is actively deployed as loans and investments. This allows banks to create credit beyond the actual cash in the system, multiplying economic activity. However, it also makes banks vulnerable to runs if too many depositors withdraw at once. Understanding this system is key to grasping both the power and fragility of modern banking. Large commercial bank is a collection of specialized divisions, each managing distinct functions. Operations handle daily transactions and settlements. Loans and credit departments evaluate and manage lending products. Risk management monitors credit, market, and operational risks. Compliance ensures regulatory adherence, while Treasury manages the bank's funds. Retail banking is the customer-facing side, and IT and cybersecurity protect digital platforms. Internal audit reviews operations to detect fraud and errors. This structure explains why banking decisions are complex and multi-layered. Every loan application is a risk assessment. Banks evaluate the probability that a borrower will repay and price the loan accordingly. The process involves reviewing credit scores, income, collateral, and market conditions. The 5 Cs of credit, character, capacity, capital, collateral, and conditions guide this evaluation. Banks reject loans for low credit scores, insufficient income, high debt burdens, unapproved property, or unstable employment. Understanding these criteria helps you prepare stronger loan applications. Banks use the 5 Cs of credit to evaluate loan applications: character, credit score; capacity, income verification; capital own contribution, collateral security, and conditions purpose and market context. Each factor helps banks assess risk and decide whether to approve a loan. For example, a high credit score signals reliability, while sufficient income and collateral reduce risk. These criteria ensure banks lend responsibly and protect their assets. Banks reject loan applications for several reasons. A low credit score, insufficient or irregular income proof, high debt burden, property not approved by legal or technical teams, or employment instability can all lead to rejection. Knowing these common pitfalls helps you avoid mistakes and strengthen your application. Banks use these criteria to protect themselves from risk and ensure responsible lending. Side banks, a sales-driven culture prevails. Employees operate under monthly sales targets, pushing products like savings accounts, credit cards, insurance, and mutual funds. Incentives reward volume over suitability, meaning employees may sell products regardless of whether they're the best fit for customers. Branch managers cascade pressure from regional management, making cross-selling routine. Customers may be enrolled in products without fully understanding the commitment. Knowing this helps you separate genuine value from sales pressure. Well-informed customer can navigate the sales culture inside banks. Always compare interest rates independently, read the fine print on fees, and avoid letting urgency override due diligence. By understanding how banks operate and what motivates employees, you can make smarter choices, negotiate better rates, and avoid unnecessary products. Knowledge is your best defense against sales pressure. Banks operate with leverage, lending out many times more than they hold in reserves. This amplifies profits in good times but creates vulnerability when conditions deteriorate. Risks include non-performing assets, NPAs, liquidity risk, interest rate risk, credit risk, and operational risk. High NPAs erode capital, liquidity crises can trigger bank failures, and internal fraud or cyber attacks can destabilize institutions. Understanding these risks reveals the fragility beneath banking's apparent stability. Non-performing asset, NPA, is a loan where the borrower hasn't paid interest or principal for 90 days or more. High NPAs restrict new lending and can trigger regulatory intervention. Indian banks faced a severe NPA crisis between 2015 and 2020, highlighting the importance of risk management. NPAs are a key indicator of a bank's health and stability. Liquidity risk arises when depositors withdraw funds faster than the bank can liquidate assets. This can lead to a liquidity crisis, as seen in the failure of Silicon Valley Bank in 2023, a digital-age bank run. Banks must manage liquidity carefully to avoid sudden collapses. Understanding liquidity risk helps you assess the safety of your deposits. Banks borrow short-term deposits and lend long-term mortgages. When short-term rates rise faster than long-term rates, the bank's margin compresses, turning profitable loans into losses. Managing interest rate risk is crucial for bank profitability and stability. This risk affects everything from loan rates to deposit returns. Credit risk is the chance that borrowers will default on their loans. Banks manage this through diversification, credit scoring, collateral, and loan loss provisioning. Effective credit risk management protects banks from losses and ensures responsible lending. It's a core part of every bank's operations. Internal fraud, cyber attacks, and system failures represent significant operational risks for banks. The $2 billion PNB fraud highlighted how internal control failures can destabilize even large institutions. Banks invest heavily in cybersecurity and internal audits to detect and prevent such risks. Operational risk is a growing concern in the digital age. Central bank is the apex financial authority, regulating the banking sector and maintaining monetary stability. It doesn't serve retail customers, but sets policies that affect every bank. The central bank acts as lender of last resort, provides emergency liquidity, and ensures stability during crises. Its decisions shape the cost of money and influence the entire economy. Central bank sets the repo rate, the rate at which it lends to commercial banks. Raising this rate increases borrowing costs, cooling inflation. Cutting it stimulates growth by making credit cheaper. Through open market operations, the central bank adjusts the money supply, curbing inflation or stimulating the economy as needed. These tools are vital for economic stability. All commercial banks must maintain the cash reserve ratio, CRR, and statutory liquidity ratio, SLR. These buffers ensure banks have adequate liquidity even during stress periods. Regulation protects depositors and maintains confidence in the banking system. The central bank enforces these rules to prevent instability. Only the central bank can legally issue currency notes. It manages forex reserves and controls the exchange rate to prevent destabilizing currency volatility. Currency issuance is a core function, ensuring the stability and integrity of the national money supply. In a crisis, the central bank can provide emergency liquidity to systemically important banks facing insolvency. This prevents broader financial collapse and maintains stability. The lender of last resort function is crucial during economic downturns and banking crises. Banks are active drivers of growth, employment, and development. Small and medium enterprises depend on bank credit to fund inventory, equipment, and expansion. Every loan enables businesses to hire, invest, and produce, creating a multiplier effect on employment. Banks fuel economic cycles, financial inclusion, and poverty reduction. Small and medium enterprises rely on bank credit to fund inventory, equipment, and expansion. Without access to credit, entrepreneurship stalls and economic diversification slows. Banks play a vital role in supporting business growth and innovation, fueling the broader economy. Banks directly employ hundreds of thousands, but their impact goes further. Every loan disbursed to a business enables that business to hire, invest, and produce, creating a multiplier effect on employment. Banks are engines of job creation and economic opportunity. Credit expansion fuels economic booms, while credit contraction deepens recessions. The 2008 global financial crisis showed how bank failures can transmit to every sector of the real economy. Banks are central to economic cycles, influencing growth and stability. Expanding banking access to underserved populations is a proven mechanism for poverty reduction. Initiatives like Jan Dhyan accounts, microfinance, and mobile banking bring financial services to those previously excluded. Financial inclusion empowers individuals and communities, driving development. Last decade has transformed banking through technology. Digital platforms compress the cost of financial services and open access to populations previously excluded. Unified Payments Interface, UPI, enables instant, zero-cost bank transfers, making banking accessible to anyone with a smartphone. Banks remain the underlying infrastructure, even in the app-based payments era. Tech companies are unbundling traditional banking, offering lending, investment, insurance, and payments as standalone services. Neobanks operate entirely through apps, with no physical branches, passing savings to customers through better rates and fewer fees. Technology is reshaping how banking is delivered, making it faster and more accessible. AI is revolutionizing banking. Credit underwriting uses AI models to analyze thousands of data points, assessing creditworthiness beyond traditional scores. Real-time fraud detection flags anomalies within milliseconds. AI-powered chatbots handle routine customer service, and machine learning models simulate stress scenarios across loan portfolios. Technology is making banking smarter and safer. Central bank digital currencies, CBDCs, are being piloted worldwide, including India. Embedded finance integrates banking products directly into e-commerce, SaaS, and healthcare platforms. Open banking allows third-party apps to access customer financial data with consent for personalized services. The future of banking is digital, integrated, and customer-centric. Understanding the accounting and strategic logic of banks reframes your relationship with them. Deposits are liabilities, banks owe you money. Loans are assets, banks earn from them. Banks prefer borrowers over savers, as borrowers generate more revenue. Your money funds other people's loans, making you an indirect lender. Not all banks are equally safe, and profit depends on risk appetite. These truths help you make informed decisions. On a bank's balance sheet, your savings account is classified as a liability. The bank owes you money. A loan you take from the bank is its asset. The bank's entire business model depends on managing this liability-asset gap profitably. Understanding this accounting logic is key to seeing how banks operate. From a revenue perspective, every new borrower is worth more than every new depositor. Borrowers generate 9–12% interest income, while depositors cost the bank 5–7%. This is why loan products are marketed aggressively. Understanding this preference helps you see why banks push loans and credit cards. The money sitting in your savings account is not idle. It's funding mortgages, business loans, and personal credit facilities across the bank's customer base. You are, in effect, an indirect lender. This interconnectedness is a core part of the banking system. Not all banks are equally safe. In India, deposits are insured up to Rs. 5 lakh per depositor per bank. Beyond that, deposit safety depends on the bank's financial health. Small cooperative banks carry higher risk than nationalized banks. Diversifying across institutions reduces concentration risk. Banks that chase high yield, high-risk lending grow fast in good times but accumulate NPAs rapidly in downturns. Conservative banks grow slower but remain solvent through economic cycles. The difference is risk management culture. Understanding a bank's risk appetite helps you choose where to deposit or borrow. Banks are not neutral public utilities. They are profit-driven institutions operating within a regulatory framework. Every product, rate, and policy is shaped by the need to generate returns while managing risk. For informed individuals, this knowledge is empowering. You can negotiate better loan rates, avoid unnecessary products, and choose banks with stronger balance sheets. Banks create credit through fractional reserve banking, multiplying money in the economy. The interest spread is the foundation of bank profitability. Your credit score is your most valuable asset in your relationship with a bank. Bank employees operate under sales targets, always verify product suitability independently. The central bank sets the cost of money for the entire economy. Digital transformation is making banking faster and more accessible, but the underlying economics remain unchanged. Deposits are insured only up to Rs. 5 lakh. Diversifying across institutions reduces concentration risk and protects your savings. Understanding deposit insurance limits is crucial for managing your financial safety. The most powerful position you can occupy as a banking customer is one of informed engagement. Understand what banks want from you and what you need from them. Let knowledge, not urgency, loyalty, or habit, drive every financial decision you make. This approach empowers you to make smarter choices and protect your interests. Banks are complex, profit-driven institutions that shape the economy and influence every financial decision you make. By understanding their mechanics, risks, and motivations, you can engage with banks from a position of strength. Use this knowledge to negotiate, choose wisely, and make decisions that serve your financial goals. Remember, knowledge is the real financial asset. Let it guide your banking journey.